Hello, good morning, Amma. Good morning, all of you. Now I'll discuss one of the problem in the mutual fund. So it is a typical problem. Lot of conceptual knowledge is involved in this problem. Okay, let me read the problem once. On 1st April, an open-ended scheme of mutual fund had 300 lakh units outstanding with net assets value of rupees 18.75. At the end of April, it issued 6 lakh units at opening NAV plus 2% load, adjusted for dividend equalization. At the end of May, 3 lakh units were repurchased at opening NAV less 2% exit load, adjusted for dividend equalization. At the end of June, 70% of its income was distributed. Okay. In respect of April to June quarter, the following additional information are also available. Portfolio appreciation, income of April, income for June. You are required to calculate income available for distribution, issue price at the end of April, repurchase price at the end of May, and net assets value as on 30th June. Okay, great. Very good problem. A lot of conceptual knowledge is involved in this problem. Okay, so before starting the calculations, let me explain some of the some of the concepts involved in this problem. So the first concept is open-ended scheme. What is meant by open-ended scheme? That is the first concept you have to learn. And the second concept is exit load. What is the exit load? So another load is also given, entry load. That is only for this problem, but in reality, no entry load. SEBI has already abolished the entry load. So therefore, I'm not going to discuss the entry load. I'll solve the problem, but there is no discussion of entry load. Okay, exit load is there. As of now, SEBI has completely abandoned the entry load. Okay, right. Next, dividend equalization. Dividend equalization. So what is the open-ended scheme? What is dividend equalization? What is exit load? And what is the difference between this income and net assets value? What is the difference between this income and net assets value? What is the difference between those two? How to calculate those? Okay, right. So let me start with explaining the difference between open-ended fund and closed-ended fund. Open-ended fund and closed-ended fund. Okay, right. Look at this. So in case of open-ended fund or open-ended scheme and closed-ended scheme, open-ended scheme and closed-ended scheme, open-ended scheme and closed-ended scheme. Okay, right. Next, in case of open-ended scheme, investors and mutual fund, So investors can subscribe the units at any time. Investors can subscribe the units at any time. Subscription of units. This is subscription of units. Next, redemption of units. Nothing but purchase of units and sale of units. But the appropriate terminology is subscription of units and redemption of units. Subscription of units and redemption of units. This happens continuously. So continuous facility is given. So this happens continuously. So this happens continuously. So continuously, regularly, investors can purchase from the fund continuously. Continuously is permitted between the investors and the mutual fund. At any time, they can purchase the units from the fund. At any time, they can sell the units from the fund. This is the open-ended scheme. But in case of closed-ended scheme, investors, mutual fund, okay, investors and mutual fund. So investors will purchase the units, will subscribe to the units, same subscription of units and redemption of units and redemption of units. This is possible even in closed-ended fund also. It is not that in closed-ended fund that is not permitted. It is possible even in case of closed-ended funds also. But the difference is that only at certain intervals. That means whenever the fund chooses to issue the new units, the unit holders will be able to subscribe. Whenever the fund chooses to repurchase the units, the unit holders will be able to redeem the units. That means the choice lies with the fund. The choice lies with the fund. Whenever the fund wants to issue the units, the unit holders can subscribe. When the fund wants to repurchase the units, only at that point of time we can redeem the units. But here it is not like that. Here the discretion lies with the investors. Whenever they want to purchase, whenever they want to subscribe, fund issues. Whenever they want to redeem, fund repurchases. Here, whenever the fund issues, you have to subscribe. Whenever the fund repurchases, then only you have to redeem. That means the discretion is with the fund. The discretion is with the fund. Okay, that is what the point. That is the basic difference. So then, how the investors will purchase and sell, sir? If the investor wants to purchase and sell at later point of time, then what he has to do? That will be listed in the stock exchange. Whatever the units that has been given, that will be listed in the stock exchange or secondary market. It is not correct to call it as a stock exchange. The appropriate word is secondary market. It may be out of stock exchange also. It is called as a secondary market. Okay, secondary market. Okay, so investors can purchase and sell. Investors can sell and purchase. Investors can sell and purchase continuously. Investors can purchase and sell continuously. Even in closed-ended fund also, we can purchase and sell continuously. We can purchase and sell continuously, but in the stock market or secondary market, not directly with the fund. Not directly with that. Both the cases. So in both the cases, you can purchase the units and you can redeem the units. But where, when and where is important. At certain intervals, whenever the fund issues, you can directly purchase from the fund. Whenever the fund decides to repurchase, you can directly redeem to the fund. During the period, during the intermediate period, when the fund is not making any new issues, at that time, if you want to purchase, you have to go to the market. Whenever the fund is not repurchasing, if you want to sell, at that time, you have to go to the secondary market. Okay, ma? Right. So this is the difference between an open-ended fund and closed-ended fund. The difference is important before learning the necessity of exit load. One of the concepts which we use in this problem is the exit load. To learn the exit load, we need to understand the difference between open-ended scheme and closed-ended scheme. Okay, ma? Right. So let me give in a descriptive way the difference between open-ended fund and closed-ended fund. Open-ended fund, next closed-ended fund. Open-ended fund and closed-ended fund. Okay, ma? Next, this is also closed-ended fund. Both. So I think I can match it. Okay, I can match it. Okay, open-ended fund and closed-ended fund. Look at this point. Okay, so mutual fund issues units whenever when the investors wants to subscribe. Whenever the investors wants to subscribe. Whenever investors wants to subscribe. Okay, whenever investors wants to subscribe. Here, investors shall purchase. Investors can purchase the units. Investors can purchase the units. Investors can purchase the units only when the fund chooses to issue. Only when the fund chooses to issue. This is the point. Discretion is with the fund. Next, here mutual fund repurchases the units. Mutual fund repurchases the units whenever investors, whenever unit holders, before they purchase, they are called as simply investors. Once they purchase the units, they are called as unit holders. Okay, mutual fund repurchases the units whenever unit holders wants to redeem the units. Okay, next. So investors can redeem the units. Investors can redeem the units only when the fund chooses to repurchase. Only when the fund chooses to repurchase. The discretion is with the fund. In case of closed-ended scheme, the discretion is with the fund. Only when the fund chooses to repurchase. This is the basic difference. Whenever they want to subscribe, fund issues. Whenever they want to redeem, the fund repurchase. Here, they can purchase only when the fund issues. They can redeem only when the fund decides to repurchase. Okay, right, having discussed. So then what to do, sir? At other points of time, what to do? Okay, at other points of time, okay, right. So in other times, at other times, investors can purchase the units from the secondary market. At other times, investors can sell the units can sell the units in the secondary market. Okay, so this happens at certain intervals. This happens at certain intervals, and this happens at other times. Okay, ma? Let me insert one more. Oh, sorry. At certain intervals, next at other times. Other times. At certain intervals, and this is at other times. Okay, ma? This is at other times. Okay, so this is open-ended fund and closed-ended fund. In case of open-ended fund, whenever they want to purchase, the fund issues. Whenever they want to redeem, the fund repurchases. But in case of closed fund, whenever the fund issues, they have to purchase. Whenever the fund repurchases, they have to redeem. At other times, what to do, sir? At other times, what to do? They have to deal with the secondary market. Other times, they deal with the secondary market directly with the fund. Look at this point, certain intervals. So at certain intervals, we have to purchase from the fund. At certain intervals from the fund. At certain intervals, directly from the fund. Or directly from the fund. At other times in the secondary market. They can deal in the secondary market at other times. Both purchase and sell directly from the fund. And indirectly in the secondary market. This is what the basic difference between an open-ended fund and a closed-ended fund. Okay. Having discussed the open-ended fund and closing-ended fund, now we'll discuss the necessity of exit load. As I discussed, as of now, entry load is not there. This is given in the problem, examination problem, but in reality, there is no entry load as of now. SEBI has abolished the entry loads. Okay, right. So therefore, I am directly going to the exit load. Okay, right. So what is exit load? Okay, look at this concept. Exit load. Exit load. Okay, exit load. The necessity of exit load arises in case of open-ended funds, not in case of closed-ended funds. Because in case of closed-ended funds, there is no disturbance to the investment portfolio. There is no disturbance. Whenever the fund wants to issue, then only it will issue. At other times, investors are not disturbing the fund. They are dealing in the secondary market. Therefore, in case of closed-ended fund, there won't be continuous disturbance to the fund. But in case of open-ended fund, there will be a continuous disturbance to the investment portfolio. Look at this point. Okay, look at this point. In open-ended funds, due to the sudden exit of some unit holders, the fund may be forced to sell their investments, forced to sell its investments, so as to redeem the exit, units and pay the money to the unit holders. Okay, this is what the point, and pay the money to the unit holders. So whenever they want to redeem, the fund has to repurchase. For that, if the fund has cash equivalents, if the fund has sufficient cash equivalents, then the fund can use the cash and redeem the investments. But if the fund does not have any sort of cash equivalents, or the redemptions are exceeding the cash equivalents, then the fund is forced to sell the investments. As if you have liquid cash, we'll pay the creditors by using the liquid cash. If you don't have any liquid assets, we have to sell our fixed assets to pay the creditors. As simple as that. If we have a current assets like cash equivalents, we can use them to repay the creditors. If you don't have a current assets, but the creditors are forcing us, what to do? No option is left to us. We have to sell the fixed assets. But selling the fixed assets will reduce the income earning capacity. In a similar manner, selling the investments will reduce the fund. Okay, will reduce the fund. Right. Next, so such sudden sale of investments. Such sudden sale of investment by the fund may reduce the market price, of the units, may reduce the market price of the investments, This is what the problem. Okay, due to the sudden exit, firm may be forced to sell the investments. Such sudden sale may reduce the market price of investments. Such a reduction in market price affects the value to the continuing holders, continuing unit holders. Therefore, to compensate the continuing unit holders, and discourage the early exit, and discourage the sudden or early exit, and to discourage the sudden or early exit, the fund charges exit load. The fund charges exit load from those unit holders, who wants to redeem their units. This is what as simple as that. Okay, so two aspects, two purpose will be served. Two purpose will be served by charging the exit load. One is since the continuing unit holders are affected by the exit by some of the unit holders, to compensate. Continuing unit holders will be affected by the exit of some of the unit holders. Remember the golden point. Continuing unit holders will be affected by the exit of some of the unit holders. That is first point. For them, we have to compensate. Another point is that we have to discourage the sudden exit. We have to encourage the investors to stay with the fund for a long period of time. We have to encourage the investors to stay with the fund for a long period of time. In order to discourage short-term redemption, we are charging exit load. This is the purpose of charging exit load. Okay, right. So therefore, to understand the exit load, first of all, you have to understand the open-ended scheme. In case of closed-ended scheme, this problem will not be there to the fund, because whenever they want to subscribe, the investors are going to the secondary market. They are not disturbing the fund. That means fund's investment portfolio is not affected. That is the point. Okay. So therefore, exit load is most important for the open-ended fund. Okay, right. Next. So having discussed this open-ended scheme and exit load, next we'll discuss the dividend equalization. What is meant by dividend equalization? Look at this. Dividend equalization. Dividend equalization. Okay. So dividend equalization. Okay, right. So dividend equalization. So this is what happens is income retained. For that, this is relevant. Dividend equalization. Okay, the entire income earned by the fund. May not be distributed. To the unit holders. This is what the point. Okay, the entire income earned by the fund may not be distributed to the unit holders. Some income may be retained in the fund itself. To distribute it. So with a view to distribute in later point of time. With a view to distribute later point of time. With a view to distribute in future. Okay. Later. Why? Because always markets may not flourish. Today the market is high. Okay. Today the fund is getting good income. Okay. But suddenly, what if the fund crashes and the investors are in need of the liquidity? Investors are in need of the income. So therefore, if the fund earns more income than what is perceived, rather than distributing the entire income, fund will distribute certain amount and they will retain certain amount in the fund. Right. So this income, whatever we have retained, that will distribute in future. But here the problem is, okay, if new investors enter the fund, they will also be eligible for distribution, eligible for a dividend whenever the fund distributes in future. Whenever the fund distributes the dividend in future. This is what the problem. If new investors enter the fund, they will also be eligible, because the fund has to distribute the dividend to all the unit holders, whoever is there in the fund as on the record date. Okay, when they have purchased, it is immaterial. I might have purchased the units of the fund 10 years back. You might have purchased the units of the fund just 1 month back. But both will be eligible for a dividend, because both are staying in the firm as on the record date. That is the concept. I am staying with the fund for past 10 years. You entered the fund only 1 month back, but both will get the dividend. But the time when the fund is earning the income, at that time I am there in the fund, you are not there in the fund. So therefore, therefore strictly speaking you are not eligible for the dividend. But legally the fund is forced to pay dividend to all the unit holders existing as on the record date. Therefore, to comply with the legal provisions at the same time to justify to the existing unit holders, we are using this concept called as dividend equalization. To comply with the legal provisions and to justify the existing unit holders, we are using this concept called as dividend equalization. Okay, right. So if the new investors enter the fund, they will be eligible for a dividend, whenever the fund distributes in future. But they are not eligible for that fund. But they are not eligible for the dividend. But they are not eligible for such dividend. Therefore, though they have legal right, though newly entered unit holders has a legal right to receive the dividend, but logically speaking, they are not eligible. Logically speaking, on an equity basis, they are not eligible. Okay, so they are not eligible for such dividend, but they are not eligible for such dividend. Okay, but they are not eligible for such dividend. So therefore, the fund charges them at the time of entry. At the time of entry. Therefore, the fund charges dividend equalization from them. Therefore, the fund charges dividend equalization from them at the time of entry. To compensate this, firm charges the dividend equalization at the time of entry. That means new unit holders, whatever they will get in future, for which they are not eligible, they have to pay in advance to the fund. That means as if we are paying money today, and tomorrow you are getting the same money. You means new unit holders. You means newly entered person. Okay, the new entrant, whatever the new entrant will get in future, for which he is not eligible, that he has to pay in advance to the fund at present. Okay, whatever the new entrant will get in future, for which he is not eligible, he has to pay in advance the same amount to the fund at the time of joining. Okay, that is what the point. Okay. Right. So this is in case of entry, but the same thing happens in case of exit also. The same thing happens in case of exit also. This is the entry. At the time of exit also the same thing happens, but in a reverse way. Okay, but in a reverse way. Look at this. When some of the unit holders exit the fund, when some of the unit holders exit the fund, when some of the unit holders exit the fund, okay, they will not be eligible, they will not be entitled, they will not be legally entitled for the dividend, which may be distributed, for the dividend which may be distributed by the firm in future, which may be distributed by the fund in future. This is what the point. Today you are existing. Tomorrow the fund will distribute the dividend for which you are not eligible. Today you are exiting from the fund. Tomorrow the fund distributes for which you are not eligible, because legally you are not there on the record date. That is the point. So therefore they will not be eligible, legally entitled for the dividend which may be distributed by the fund itself. But they are entitled for that. They are not legally entitled, but they are eligible for that. So therefore the fund pays them dividend equalization. Therefore the fund pays them dividend equalization amount at the time of exit. This is what the point. Okay, dividend equalization is charged and paid. Dividend equalization is charged at the time of entry and paid at the time of exit. Okay, so this is what the point, dividend equalization. Now, before going to this, just let me give one more description of these differences between dividend equalization at the time of entry and dividend equalization at the time of exit. Okay. Look at this. Dividend equalization charged at the time of entry, charged by the fund. Look at this point, charged by the fund from the unit holders, from the new entrant, from the new unit holders, at the time of joining, at the time of subscription, okay. Next, dividend equalization paid by the fund, not charged, paid by the fund to the unit holders, at the time of redemption, This is what the point, at the time of redemption. So this is applicable to the new unit holders. This is applicable to the incoming unit holders. Okay. Next, outgoing unit holders. outgoing unit holders, incoming unit holders and outgoing unit holders. This is what the point. Next, at present, in future, at present, in future, at present, in future, pay in advance, 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 to pay in advance for which you are not eligible, pay in advance. Okay, now get in future, get dividend in future, get dividend in future for which you are not eligible, for which not eligible, for which you are not eligible, for which you are not eligible. You means investor, you means existing investor. Pay now, get later, pay now, get later. Okay, pay now, get later, pay now, get later, as simple as that. Okay, pay now, get later, that means just a reimbursement, just a reimbursement, no question of no income, no income for them, just a exchange of cash, that's it. Pay now, get later, pay now, get later. So here you may argue with the time value of money, that is not considered here. Time value of money, just we are treating it, whatever you pay now you will get in future, as simple as that one. Whatever you pay now you will get in future, pay now, get later. This is to whom? This is to whom? Incoming unit holders. This is to whom? Incoming unit holders. And when it comes to the outgoing unit holders, outgoing unit holders, okay, get now, get now, okay, get now, okay, get now, get now, don't sacrifice later, get now, sacrifice later. Okay, that means here get now, whatever you may not get in future, as simple as that. Okay, get now what you may not get in future, get now what you may not get in future, you may not get in future, what you may not get in future, as simple as that. Pay now what you may get in future, get now what you may not get in future, as simple as that. Pay now what you may get in future for the existing unit holders, pay now whatever you get in future, get now whatever you may not get in future. You may understand, get now whatever you may not get in future, pay now whatever you may get in future, whatever you may get in future. This is the difference between the dividend equalization at the time of entry and dividend equalization at the time of exit. Okay, ma? So this is the concepts, open-ended scheme and closed-ended scheme, dividend equalization and exit load. Next, so before solving the problem, first we understand this concept, income distribution and NAV. Many aspects has been given, many aspects has been given. We have to understand the treatment for that. So basically income statement, income distribution, income available for distribution is a revenue item. Income available for distribution, income available for distribution is a revenue item, is a revenue statement, is a revenue statement. Okay, net assets value is a balance sheet item, net assets value is a statement of affairs item, net assets value is a balance sheet item, net assets value is a balance sheet item. Okay, that means since it is a revenue statement, only revenue items are considered. Capital receipts and capital payments are not considered. Here you'll consider everything. So capital payments are directly routed through this point. Therefore, the logic is very simple. Okay, revenue items are directly reflected in the income statement, directly reflected in the income statement, indirectly captured, aggregate effect of revenue items, aggregate effect of revenue items, aggregate effect of revenue items are indirectly, are in aggregate effect of revenue items are ultimately reflected in balance sheet. Am I correct or not? Ultimately reflected in balance sheet, because whatever the profit and loss account, the closing balance of the profit and loss account, net profit, that will be transferred to the reserves only. Reserves is the balance sheet item. Therefore, aggregate effect of revenue items are ultimately reflected in the balance sheet. There is no confusion about that. But capital items, okay, capital items are directly by capital items, revenue items are directly reflected in the income statement one by one, on one-on-one basis, on one-to-one basis, on one-to-one basis. Because aggregate is reflected in balance sheet. Capital items are directly reflected in balance sheet. Capital items are directly reflected in balance sheet. Capital items are directly reflected in a balance sheet on one-to-one basis, on one-to-one basis, on one-to-one basis. Straight away, one by one. One by one, they will include not only the aggregate effect. Revenue items also get reflected in the balance sheet, but aggregate effect indirectly. So here directly capital items. So therefore, we have to understand out of the items they have given, out of the data they have given, we have to identify which is a revenue item, which is a capital item, which has to be reflected. Okay, right. Next. So first, let me list out the items they have given in the question. So based on that, we can think about it. Let me discuss the items given in the problem. Based on that, we can discuss. whether to charge it or not. First, look at the items. What is the first? We'll write the nature of receipt, nature of amount, nature of item. Whether it is a capital receipt or payment, revenue receipt or capital receipt or payment. Okay, ma? Nature of item, nature of item. Next, after discussing the nature of item, income statement, whether considered, if so, how? If so, how? If so, how? Next, income statement. Next, net assets value statement. Income statement, income available for distribution. For computing income available for distribution. For computing income available for distribution. For computing income available for distribution. So here for computing net assets value. For computing net assets value. For computing net assets value. Okay. Whether considered, if so, how? If so, how? Okay, if so, how? That is what the point. Now look at this. What is the first receipt? Whatever they have given, the first item they have given is entry load. Opening load at the time of issue. Look at this point. Load at the time of issue. That is called as entry load. That is called as entry load. So entry load is a capital item. Entry load charge. Entry load is a capital receipt. Entry load is a capital receipt. Entry load is a capital receipt. Since it is a capital receipt, it is considered, whether it is considered in the income statement, the answer is no. The answer no. If there is no, it is not applicable. It is not applicable. Whether it is considered, the answer is yes. Whether it is considered, the answer is yes. How? As an income, added to the net assets, added to the net assets. This is what the point. So whether it is considered, yes. If so, how we have to consider? Whether it is considered, if it is no, okay, fine. Right. Next, this is the entry load. Entry load, capital. Look at this point, capital. So capital means, therefore, it is considered, it is not considered here. Receipt, therefore, added. As simple as that. Okay. So to understand whether it is a capital receipt or capital payment, revenue receipt or revenue payment. Okay, ma? Right. Next. So this is the entry load. Next information they have given is exit load. Exit load. It is also a capital receipt. It is also a capital receipt. It is also a capital receipt. So therefore, the same thing happens. Both are a capital receipts. Therefore, both are same treatment. Both are same treatment. Added to the net assets value of the fund. Okay. This is the points. Let me delete this rows. So this is the point, whether added to the fund, yes. Whether how added to the net assets. This is what the point. Next, dividend equalization. Look at this point. Dividend equalization. Dividend equalization. Charged at the time of issue. Charged at the time of issue. Charged at the time of issue of units. It is a revenue receipt. Charged. Therefore, it is a revenue receipt. Whether it is considered, yes, the answer is yes. It will be considered. Whether it is considered, the answer is yes. It will be considered. Okay, this is the point. Capital receipt, dividend equalization charge at the time of issue of units. Dividend equalization charge at the time of issue. Dividend equalization charge at the time of issue. Okay, right. So it's a revenue receipt. Therefore, it is considered. Therefore, it is considered. Since it is a revenue receipt, we will consider that receipt. Yes, sir. How it is considered? Added to the income. Added to the income. Added to the income. Because the income receipt added to the income. Whether it is considered, yes. How? Indirectly as the aggregate effect of income. Indirectly as the aggregate effect of income as the aggregate effect of income. Next, dividend equalization paid at the time of issue, paid at the time of redemption, paid at the time of redemption. Dividend equalization paid at the time of redemption. So it is paid. Dividend equalization is paid by the fund. So therefore, it is a revenue payment. 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 Is it considered? Whether it is considered, the answer is yes. It is a revenue item, but deducted from the income. Deducted from the income, as simple as that. Deducted from the income. Deducted from the income. Whether considered, yes, same. Whatever the revenue items are there, that will be considered indirectly to the fund. Indirectly to the fund, aggregate effect. Next, after that, so this is the theory, this is the completed. So entry load is completed, dividend equalization is completed, exit load is completed, dividend equalization at the time of exit, all are completed. Now look at this point, portfolio appreciation. Look at this point, portfolio appreciation. Portfolio appreciation. So it is portfolio appreciation. What is the nature of this? It is an unrealized profit. Unrealized profit. So therefore it is not considered, not applicable. Very important point. Okay, portfolio appreciation is only a book item. Portfolio appreciation is only a book item. It will not be considered. It will not be considered income because it's a revenue item. It is a revenue statement. Only revenue items and realized profits has to be considered. Unrealized profits are not considered. I have purchased the share at 100 rupees. Now the market price is 180. I can book 80 rupees as a book profit, but I don't have 80 to distribute. As simple as that. It is only book entry of 180. I don't have that 80 to distribute because I have not yet sold. Just get the logic. I purchased the share at 100. Now the share is quoting at 180. Therefore, I can write 80 rupees as book profit, but I don't have cash to pay that. That is an unrealized income. Unrealized income. Therefore, it is not available for distribution. Not available for distribution. Not available for distribution. Okay, ma? Not available for distribution. Income earned, it is not available for distribution. Whether it is considered, yes, directly added to the fund, added to the net assets, added to the net assets, as simple as that. Added to the net assets. Okay. Next, portfolio appreciation is done. Next, this is the income. These are the incomes. Income received by the fund from the investments. What is this income? Income received by the fund from the investor, from the investments. Unit holders, mutual fund investments. Mutual fund investments. So whatever the money invested by the mutual fund, in this investment, they will get dividend or they will get interest Now we are talking about this point. The income earned by the fund. We are talking about this point, the income earned by the fund. It is earned. Therefore, realized income. That is called as a realized profit. Therefore, available for distribution. That we have received. Therefore, available for distribution. Income earned. It is called as a realized profit. So therefore, it is whether it is considered, yes. How it is considered? Added to the income. Okay. Whether it is considered, yes. Indirectly as the aggregate effect of income. The aggregate effect of income will be reflected in the balance sheet. Net assets value statement. But these are the items given in the question: entry load, exit load, dividend equalization charged at the time of issue, dividend equalization paid at the time of redemption, and portfolio appreciation and income redemption. What is the nature of that one? What to do with that statement? This is the point for computing income available for distribution. Okay, right. Next. So having discussed this statement, now we'll go to the actual calculations. Income available for distribution. This is the first question. Income available for distribution. As we discussed above, whatever is the revenue items, that only will consider revenue and realized. Both should be there. Income available for distribution. Okay, ma? Income available for distribution. Okay, just write whatever is there for us, whatever is given. Income available for distribution. First point, income earned by the fund during the month of April. Look at this, income earned by the fund during the month of April. Fund during the month of April. Income earned by the fund during the month of April. As simple as that. Okay. Income earned by the fund during the month of April. Income earned by the fund during the month of April. Okay, that I'll write in lakhs. Next. So what is this point in lakhs? What is the income earned by the fund in April? 22.950. 22.950. This is the income earned. Now first look at this point. Next income. So if you look at, if you go by sequence, that is the first income earned by the fund during the month of April. Next, dividend equalization. Dividend equalization charged by the fund, charged by the fund at the time of issue of new units, at the time of issue of new units at the month, at the end of April, at the end of April, at the end of April, charged by the fund from the issue of new units on the new units issued at the end of April, charged by the fund on the new units issued, charged by the fund on the new units issued, on the new units issued at the end of April, on the new units issued at the end of April, on the new units issued at the end of April. Okay, so dividend equalization charged by the fund on the new units issued at the time, at the end of April. Okay, right, at the end of April. Okay, next, income earned by the fund at the end of April, dividend equalization charged by the fund on the new units issued at the end of April. So what is the, how much is the charge? This is the question mark. How much to be charged from the new unit holders? This is the important point. Okay, right, let me show you this point. So let me understand this point. Okay, right. So how much to be charged from the new unit holders? Look at this point. Okay, right. As at the end of April, as at the end of April, the fund is having rupees 22.95 lakhs. Okay, to rupees 22.95 lakhs. The time by the during the time when the, during the time when the fund earned such income, during the time when the fund earned such income, when the fund earned such income, the fund has only 300 lakhs units. 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 Remember, so the existing units are 300 lakhs. The existing units are 300 lakhs. The fund has only 300 lakhs existing units. Therefore, only those units, therefore, only such existing units are eligible. Existing units are eligible for that rupees 22.95 lakhs. For that rupees 22.950 lakhs, 95 lakhs to full extent. Full amount they said to full extent, not part of that, to full extent. However, the fund has not distributed such income. However, the fund has not distributed such income. The fund has not distributed such income. But without distribution of such income, without distribution of income already earned, without distribution of income already earned, without distribution of income already earned, the fund has issued new units. The fund has issued new units. Here comes the problem. Without distribution of income already earned. Look at this point. Without distribution of income already earned, without distribution of income already earned, the fund has issued new units. The fund has issued new units. So therefore, in future, whenever the fund distributes such dividend, whenever the fund distributes such income, not only the existing, the fund issued how many units? Right. Therefore, in future, has issued new units. How many units? New units issued. New units issued is 6 lakhs units. New units issued is 6 lakhs units. The fund has issued 6 lakhs new units. The fund is issued 6 lakhs new units issued. The fund has issued 6 lakhs units. Therefore, in future, whenever the fund distributes such income, not only the existing unit holders, will get the dividend, but also the newly entered unit holders, will also get, will also be eligible. That is what the point. Will also get the dividend. This is the point. So today you are not distributing the fund. Today we have the income, but we are not distributing it. Tomorrow, without distributing, we are taking new investors. Today we have the income, but we are not distributing to the existing shareholders. Tomorrow, if the new entrant comes, whenever the fund distributes, the fund has to distribute that to the new unit holders also. The fund has to distribute it to the new unit holders also. That is what the point. So therefore, what we are doing is that we are charging some amount. We are charging some amount from the existing shareholders. Therefore, Therefore, the fund has to charge. Therefore, the fund has to charge dividend equalization. Dividend equalization from the new unit holders, from the newly entered unit holders, from the newly entered unit holders. So here the how much to be charged? How much to be charged? The concept is fine, sir. We understood why we have to charge, but how much to be charged? It's very simple. How much to be charged is very simple. Look at this point. Whether at present or in future, whether at present or in future, whenever the fund distributes, whenever the fund distributes, whenever the fund distributes dividend, whenever the fund distributes dividend, the existing unit holders, the existing unit holders, the existing unit holders, the existing unit holders will get will be entitled for the total of rupees will be entitled for the total of rupees 22.95 lakhs, will be entitled for the total of rupees 22.95 lakhs. That is how much per each unit? How much per each unit? Total we have 22.95 lakhs. We have total 22.95 lakhs. We have total 22.95 lakhs, and the number of units are 300. Okay, this is the income and this is the units. We have 22.95 lakhs. Therefore, per unit will be this point per unit. So that is per unit 0. Per unit 0.0 how much? 0.0765 per unit 0.0765. This is what the point. Okay, so look at this point. Whether at present or in future, whenever the fund distributes dividend, the existing unit holders will be entitled for the total of 22.95 lakhs. Because the reason is during the time, look at this point, during the time when the fund earned such income, the fund has only 300 lakh units. Therefore, only such units are eligible. Therefore, they are eligible for full amount. They are eligible for full amount. So therefore, that is first you have to understand this point. Okay. Therefore, to in future, if the company distributes dividend, the fund shall distribute at least rupees 0.0765 per unit to the existing unit holders, Okay, right. Next question comes is at the time of distribution, the fund shall also distribute the same amount per unit. The fund shall also distribute the same amount per unit, amount. The fund shall also distribute the same per unit amount to the newly entered unit holders also. This is because as per law, all the unit holders staying with the fund, as on the record date, are eligible for dividend, for which they are not entitled. Eligible for dividend. That is what the point. So therefore, if the fund wants to distribute 0.0765 to the existing holders, the fund shall also distribute 0.0765 to the unit holders. That means as the firm is paying rupees 0.0765 to the existing unit holders, the firm shall also pay the same amount to the new unit holders also. That means new unit holders will get 2.5. That means new unit holders will get rupees 0.0765 in future, for which they are not entitled, So therefore the same amount shall be paid. By such new unit holders at the time of purchasing the units, at the time of subscribing the units. As simple as that. Very simple. Okay, how much to be charged from the new unit holders? Look at this point. This is the total amount for which the existing 300 lakhs units are eligible. Okay, the existing 300 lakhs units. the existing 300 lakhs units will be entitled. You will be entitled for the total amount of rupees 22.95 lakhs, but that is 0.0765 per unit. 0.0765 per unit. Look at this concept, 0.0765 per unit. Okay, so why we are charging 0.0765 per from the new unit holder? This is the logic. Okay, whether the fund distributes at present or in future, whenever the fund distributes, the fund has to pay 22.95 lakhs to all the 300 lakh units. That is the conclusion. Okay, there is no change in that. Whether the fund distributes at present or in future, the fund has to pay total of 22.95 lakhs to the 300 lakhs units. That means per unit 0.0765. Okay, after 4 months or after 5 months, firm will distribute. Firm will distribute the same amount to the unit holders. Firm will distribute the same amount to the 300 lakh unit holders. But legally speaking, at the time of distribution, new unit holders are also there in the fund. At the time of distribution, new unit holders are also there in the fund. So therefore, for them also the fund has to pay the same amount. The firm is paying to the existing unit holders will get the same in future, because the same amount will be paid to the new unit holders also. That is what the point. The firm, whenever the fund distributes, the fund has to pay the same amount to all the unit holders existing as on the record date. Existing as on the record date. So new unit holders are also eligible. Say the fund shall distribute to the new unit holders also, because as on the record date they are saying, but for which they are not eligible. They are not eligible. For which they are not eligible, they are not entitled. So that means new unit holders will be getting 0.0765 per unit in future, for which they are not entitled. Therefore, they have to pay the same amount to the fund at the time of joining. Be clear, ma? New unit holders will be getting 0.0765 per unit in future whenever the fund distributes, for which they are not entitled. So therefore, the fund has to collect the same amount from them. Okay, that is what the point. So this is per unit. This is per unit. Therefore, total amount to be collected from the 6 lakhs unit holders. Dividend equalization charged by the fund on the new units issued at the end of April. So this will be 22.95 lakhs divided by 300 lakhs divided by 300 lakhs into 6 lakhs into 6 lakhs into 6 lakhs units into 6 lakhs new units issued into 6 lakhs new units issued. This is what the point. So tomorrow in future they will get this amount, like the existing unit holders. Like the existing unit holders, they will get this amount also. So therefore, per unit they have to pay 0.0765. In total, they have to pay how much, ma? So this is 0.0765 per unit. 6 lakhs newly issued units. So therefore, the total will be 0.459 lakhs. 0.459 lakhs. 0.459 lakhs. Okay, this is what the point. Dividend equalization charged by the fund on the new units issued at the end of April. Next, income earned by the fund during the month of April. May. Income earned by the fund during the month of May. Income earned by the fund during the month of May. What is the income earned by the fund during the month of May? 34.425. 34.425. Okay. 34.425. Okay, 34.425. Next, when the fund is redeeming the units, the fund is repurchasing the units at the end of May. At the end of May, the fund is repurchasing the units. At the time of repurchase, fund will pay the dividend equalization. At the time of repurchase, fund will pay the dividend equalization. It is not that the fund is collecting, the fund is paying the dividend equalization. Okay, right. Next, look at this. So dividend equalization paid by the fund on the units repurchased at the end of May. On the units repurchased at the end of May. How much dividend equalization to be collected? Same. What is the income eligible? What is the income existing as on this date? What is the income existing as on this date? Take out the cumulative amount. Take out the cumulative amount. Okay, ma? Take out the cumulative amount. Income available for distribution. Income available for distribution. Income available for distribution at the end of May. At the end of May. Okay, income available for distribution at the end of May. Okay, what is the total? Do the total 22.950. 22.950. Next 0.0459. Next, how much it is? 34.425. 34.425. How much will get? We'll get 57.4209. 57.4209. 57.4209. We will get 57.4209. Okay, at the end. So the same amount. So the same amount you have to pay per unit. So this is the amount eligible for all the 306 unit holders. This is the amount for which all the 306 unit holders are eligible. Okay, therefore, how much they have to pay? Rupees 57.4209 lakhs divided by how many units? 306 lakhs units existing as on the date. As on the date, we have 306 lakhs units. As on the date, we have 306 lakhs units. Into how many units we are redeeming? How many units you are redeeming? Look at the question. How many units we are redeeming? We are redeeming 3 lakhs units. We are redeeming 3 lakhs units. Therefore, into 3 lakhs. Into 3 lakhs units. This is what the point. This is what the amount you have to charge. Okay, 57.4209 divided by 306 into 3. 57.4209 divided by 306. 57.4209 divided by 306. This is per unit amount eligible. The 3 lakhs units are going out of the fund. So therefore, this is what the point. 0.5629. 0.5629 per unit. Sorry, in total 0.5629. 0.5629 will be deducted. In the above table, I have given how to treat it. In the above table, I have given dividend paid at the time of dividend equalization, paid at the time of redemption, deducted from the income because it is a revenue payment. Because it is a revenue payment, it has to be deducted from the income. Okay, ma? Right. This is the point. So this is the amount. So this is the total amount available for this. This persons are eligible. Out of this persons are going out. Okay, as the total income available, total units outstanding, per unit available, per unit amount you will get. So how many people are going out? 3 lakhs units. Therefore, into 3 lakhs units total amount to be paid. Okay, ma? Right. This is the dividend equalization number. Next, income earned by the fund. Income earned by the fund during the month of May, during the month of June. Sorry, income earned by the fund during the month of June. What is the income earned by the fund during the month of June? 45.450 rupees. 45.450 rupees. 45.450. So therefore, the total income available. So the total, this will be deducted from this 57.29 lakhs. This will be deducted, and 45.450 will be added. 45.450 will be added. The total will be 102.308. The total will be 102.308. Okay. Total income available for distribution at the end of June. How much it is? It will be 102.38. 102.308. 102.308 before distribution. 102 point before distribution. Total income available for distribution at the end of June. Okay. Next, after distribution, income distributed by the fund. Look at the problem. They have given one more information in the problem. 70% of its available income was distributed. 70% of its available income was distributed. So therefore, out of the above into 70%, less income distributed, less income distributed at the rate 70%, income distributed at the rate 70%. So 102.038 into 70%, how much I'll get? 71.6156. 71.6156. Okay. Next, we have to write income available for distribution. Income available for distribution after distribution. Income available. Income retained. I should say income retained. How much is the point? I should say income retained. I should say how much is the income retained? It's 30.6924. 30.6924. 30.6924. Okay. This is the end answer. Okay. So let me put in the green color because the final answer. Okay. 30.6924. 30.6924 is the income retained after distribution of 70%. This is the what is the amount available in the fund. Okay, right. Next, this is the first question. This is the first question we have answered. Next, look at the second question. What is the second question? Issue price at the end of April. Very clear. So they have already given this point. Issue price at the end of April. At what price they are issuing the price? At the end of April, it issued 6 lakhs units at opening NAV plus 2% load adjusted for dividend equalization plus 2% load. Entry load we have to add. Entry load we have to add. And dividend equalization also should add. Dividend equalization should also be added. Okay. Right. So at the end, issued at opening NAV. Opening NAV means at April NAV 18.75. Opening NAV means 18.75. Look at this concept. What is the question, ma? What is the question exactly? What exactly is the question? Issue price at the end of April. Issue price at the end of April. Issue price at the end of April. Okay. Issue price at the end of April. So what is the opening NAV? Opening NAV. Opening NAV. What is the opening NAV? Rupees 18.75. Rupees 18.75 is the opening NAV. Add 2% entry load. Add 2% entry load. Add 2% entry load. How much is my 18.75 into 2? How much is that? 18.75 into 2%. 18.75 into 2%. That will be 0.375. That will be 0.375. Next, add dividend equalization. Above we have already calculated dividend equalization. Dividend equalization. Add dividend equalization. Add dividend equalization. Dividend equalization. Look at this. Don't take blindly the above figure. Don't take blindly the above figure. This 0.459 is total. Total. This 0.459 is total. This is per unit. This is per unit. Don't take total. So per unit will be here also. Per unit will be this much. 22.95 lakhs divided by 300 lakhs. This is per unit. This is per unit. So therefore, how much is that? 22.95 lakhs divided by 300. We got earlier 0.0765. 0.0765. Okay. So 0.075. Don't take that 0.45. That is total. 0.0765. These are in lakhs. Remember, in the above table we wrote it as a lakhs. We wrote it as a lakhs. Yes or no? This we don't write. This is just rupees. That's it. Okay. 18.75. So therefore, issue price. Issue price. Issue price. Okay, this is the issue price. How much is that? 18.75, 0.375. Next, this amount, whatever we are getting here, this amount. So therefore, total will be 19.2015. 19.2015. Okay, 19.2015. This is the total issue price at the end of April. This is the total issue price at the end of April. This is the total issue price at the end of April. Okay. This is the total issue price at the end of April. Next. Next, what is the third question? Look at the third question. What is the third question? Repurchase price at the end of May. Repurchase price at the end of May. What is the repurchase price at the end of May? Okay. So repurchase price. Repurchase price at the end of May. Repurchase price at the end of May. Repurchase price at the end of May. Same. They have to take the same table, but the only thing is that dividend equalization to be deducted. That's it. Dividend equalization to be deducted. Dividend equalization to be deducted. Okay. Right. Next, what is the point? 18.75 is there. 18.75 is there. 2% exit load. 2% exit load. Both will be charged. Both will be charged. 2% exit load. 2% exit load. Next, this add will become less. This add will become less. Less dividend equalization. How much is that? Look at this per unit. Per unit 57.4209 divided by 306. 57.4209 divided by 306. 57.4209 divided by 306. This is what? 0.1876. 0.1876. This will be 0.1876. This will be 0.187. This is deducted. 0.1876. I have to deduct it. Dividend equalization. Sorry, add exit load. Sorry. So this is reverse because we are redeeming. Sorry, because we are redeeming. Less exit load charged. Less exit load charged. Next, they add dividend equalization paid because it's reduction, right? Add dividend equalization paid. Add dividend equalization paid. So this will be deduction. This will be deduction. 2% exit load, and this will be addition, and this will be addition, and this will be addition. Okay, right? So this is the point. So 18.25, 18 point, same. I will take this point. I'll take this, but I have to deduct this. Exit load, I have to deduct this, but for that I have to add this 0.18765. I have to add 0.1876 because in the word sheet I'm taking only 4 digits. Therefore, I have to take here also 4 digits. 18.5626. 18.5626. 18.5626. 18.5626. 18.5626. This is the repurchase price at the end of May. Repurchase price at the end of May. Next, look at the last point. Net assets value as on 30th June. Net assets value as on 30th June. The net assets value as on 30th June. Net assets value as on 30th June. Okay. Net assets value as on 30th June. Net assets value as on 30th June. Okay. Next, what are the aspects to be considered in the net assets value? It's like net assets value is nothing but book value per share. This I have discussed in a couple of problems earlier. So what is book value per share to a normal company is nothing but net assets value for a mutual fund. What is book value per share to a normal company is nothing but net assets value per share to a mutual fund. Okay. So book value per share, how will you calculate? Net worth divided by number of shares. Book value per share, net worth divided by number of shares. Therefore, net assets value is equal to net assets divided by number of units. Okay, ma? Look at this. Normal company, mutual fund. Normal company, mutual fund. So for normal company, net worth. For a mutual fund, it is net assets. For a mutual fund, it is net assets. Net worth or net assets. For normal company, also we can call it as net assets. And next, this is book value per share. Book value per share. How will you get book value per share? Net worth divided by number of shares. Here, how will you get this net assets value? Net assets value, how will you get? Net assets divided by number of units. That is the point. Same. What is book value per share to a normal company is nothing but net assets value for the unit. Only the terminology is changing, but underlying concept is same. Okay, right. So therefore, book value, net assets. Net assets. Normally, mutual fund will be having different types of assets. This also I have discussed earlier. Basically, investment portfolio plus cash and cash equivalents. Here, no information is given with respect to the cash equivalents. Look at the question. No information is given with respect to the cash equivalent. Therefore, we can ignore that point. And the liabilities. No information is given with respect to the liabilities. So therefore, portfolio investment will be considered. Okay. Therefore, portfolio investment will be considered. Look at this point. Portfolio investment. What is the original investment portfolio? Investment portfolio. Investment portfolio as at the end of investment portfolio as at the beginning of April. Investment portfolio as at the beginning of April. Look at this. What is the opening cash? What is the opening cash? In my balance sheet format, I have given the comparison of balance sheet format for the mutual fund and other companies. Go through the earlier problems. Now I'm directly solving this. Okay. So an investment portfolio as at the beginning of April. As at the beginning of April. As at the beginning of April. Look at this. How much is the investment portfolio? Net assets. Net assets 300 lakhs units. 300 lakhs units. 300 lakhs units. Per unit value they have given. They have given per unit value. 300 lakhs units. Into how much is the per unit? 18.75. Into 18.75. Into 18.75. Into 18.75. Into 18.75. This is the point. 18.75. 300 lakhs units into 18.75. Just do that calculation. 300 lakhs into 18.75. 300 lakhs into 18.75. 5625 lakhs. 5625 lakhs. 5,625 lakhs. This also will put it in lakhs. In lakhs. Okay, this will be in lakhs. 5,625. Per unit value they have given, that we have to take it as an in total. Per unit value we have given, therefore you have to take it as an in total. Per unit value is given, take it as an in total. Okay, right. Next. Next, after that, what we have done is income available for distribution. Look at the income available for distribution. This will take at the end of June. But in between we have missed out two things. What is that? Entry load and exit load. Entry load and exit load. Entry load charged and exit load charged. Entry load charged and exit load charged. So these are the points we have missed out earlier. These are the points we have missed out because they are capital receipts. Capital receipts. That is the reason we have not considered it. That is the reason we have not considered it. But for calculation of NAV, we have to collect. We have to consider those entry load and exit load. Okay, right. Take that. Take that entry load and exit load. Entry load charged. Entry load charged on units issued. On units issued at the end of April. At the end of April. At the end of April. How much we have charged per unit? Per unit we have charged how much? Per unit we have charged 0.375 per unit. Into how many units we have issued? 6 lakhs units issued. 6 lakhs units issued. 6 lakhs units issued. 6 lakhs units issued. Okay. Therefore, take that point. Per unit, how much we have charged? 0.375 into 6 lakhs units we have issued. 2.25 lakhs. 2.25 lakhs will be this point. 2.25 lakhs. 2.25 lakhs entry load charge on units issued at the end of April. Next, entry load charged on units redeemed at the end of April. Redeemed at the end of April. Entry load charged on units redeemed at the end of April. How much is that? How much we have charged? 0.375, same amount on 3 lakhs units. On 3 lakhs units, same 0.0375, same 0.375. 0.375. So, but 3 lakhs units on that where it is charged only for 3 lakhs units. Therefore, it will be 1.125 lakhs. It will be 1.125 lakhs. 1.125 on 3 lakhs units. So it will be same 0.375 to 0.375 per unit into 3 lakhs units. 3 lakhs units. Okay, this is the entry load charge. Next, income retained. Income retained. So after distribution, what is the income retained? After distribution, what is the income retained? Go back to the first point. 30.6924 lakhs. 30.6924 lakhs. 30.6924 lakhs. Okay. 30.6924 lakhs is the income retained. But the portfolio appreciation is there, which is not considered. Which is not considered. Look at this point, this entry load is done. Dividend equalization is done in the income statement. Dividend equalization is done in the income statement. Entry load and exit load is done in the directly in the NAV. These three are stated through income statement and indirectly routed to the NAV computation. But what is pending is this point. Portfolio value appreciation 425.47. Portfolio value appreciation 425.47. That better will write here. Okay. Appreciation of portfolio value. Appreciation of portfolio value. Or you can write at the end. Because it's happening at the end. Since we are taking at the end, it's better to write at the end only. Okay, portfolio appreciation. Portfolio appreciation. How much is the portfolio appreciation? It is an unrealized profit. Unrealized profit. Therefore, we are taking it to the results. Though we have not taken it to the income statement, we are taking it to the results. Because unrealized profit. That is unrealized profit. That is 425.47. 425.47. Here comes next. Let's look at the point. What else is there asset? If you look at this problem, okay. So this is the entire income we have considered. All this entire income, dividend equalization we have considered in the income. So this dividend equalization paid also we have considered an expenditure. We have considered expenditure and income earned also all income earned we have taken. But exit load and entry load also taken. Exit load, this is taken, this is taken, this is taken. Portfolio appreciation is taken. But what is missing is this point. This value. Cash, change in cash and cash equivalents, because it is the cash collected. It is the cash collected on issue of units. It is the cash collected on issue of new units. Yes or no? And it is the cash paid on redemption of units that we have not considered. That we have not considered. Okay, ma? That we have not considered. Okay, so that we have not considered. Dividend equalization paid that we have taken as a payment. Okay, therefore that is the point. Change in cash and cash equivalents that we have to consider. Change in cash and cash equivalents. Change in cash and cash equivalents. Change in cash and cash equivalents. Okay, so how much we have charged? 18.75. 18.75 per unit. 18.75 per unit into 6 lakhs units is collected. 6 lakhs units is collected and 3 lakhs units is paid into 6 lakhs units minus 6 lakhs units issued minus 3 lakhs units redeemed. Minus 3 lakhs units redeemed. Am I correct or not? We are collecting the cash and we are paying the cash. Where is the net effect? Net effect. This is the cash collected. This is the cash collected. Emma, look at this point. This is also cash collected. This is also cash collected. This is also cash collected. We have routed through income statement and ultimately routed through NAV. Done. This is a non-cash item. This is a non-cash item, unrealized item. Directly you have taken it to the NAV. Directly you have taken it to the NAV. Done. So these two treatments are correct. These two treatments are correct. Okay, ma. So this is the cash receipt. We have taken to the income statement and ultimately to the NAV. So it is a non-cash item directed to the NAV. So this exit load directed to the NAV because the revenue receipt. Entry load is also directed to the NAV because the revenue receipt. Dividend equalization. Dividend equalization. It's a revenue item. It is routed through income statement and indirectly routed through NAV. All the items have been considered. But how about this 18.75? Issue price and redemption price. Where we have captured that issue price and redemption price. Nowhere we have captured this. Look at this problem. We are collecting this issue price. We are collecting this amount. Repurchase price, purchase price, paying that amount. Where we have considered that. Where we have considered that. That is the net change in cash and cash equivalents. That is the net change in cash and cash equivalents. That we have to take it. Okay. So therefore, change in cash and cash equivalents rupees 18.75 per unit into 6 lakhs units minus issued minus 3 lakhs units redeemed. Look at this point. My net effect is 18.75. 18.75 is equal to 6 minus 3 lakhs units. So total will be 56.25 lakhs. Change in cash and cash equivalents. It will be 56.25 lakhs. It will be 56.25 lakhs. Now we have to now take the total. Total net assets value. Total net assets value as at the end of June. As at the end of June. How much is the total net assets value? Take out my everything. 5625. 5625. Next 2.25. Next 2.25. Next 1.125. And next 30.6924. 30.6924. Next 425.47. 425.47. Next 56.25. What is the total? 56.25. What is the total? The total will be 6140.79 lakhs. 6140.79 lakhs. 6140.79 lakhs. This 6140.79 lakhs. Okay. So this is the final answer. Total net assets value as at the end of June. Total net assets value as at the end of June. Let me take it. Okay. This is what the problem. Okay, right. So before solving the problem, first of all, understand how much concept is involved in the problem. First, we have to understand what is the difference between open-ended scheme and closed-ended scheme. First point, understand the difference between open-ended scheme and closed-ended scheme. Next, after understanding the difference between open-ended scheme and closed-ended scheme, next go by the exit load. Necessity of charging exit load by the unit, by the open-ended fund. What necessity? What forces the closed open-ended fund to charge the exit load? That is what the question I have to answer. What forces why the open-ended fund? Why the open-ended fund is charging? Why the open-ended fund will charge exit load? Why the open-ended fund will charge exit load? The reason you have to consider why the open-ended fund will charge exit load. That is what the point. What is meant by open-ended fund and what is meant by closed-ended fund? How the funds are operates? How the fund operates? Next, why the open-ended fund is charging exit load? Having discussed this, what is meant by dividend equalization? What is meant by dividend equalization? At the time of issue, we are collecting. At the time of redemption, we are paying. What is the logic? What is the logic? Is this point? What is the logic is this point? Okay, pay now whatever you will get in future. Get now itself whatever you may not get in future. Get now itself whatever you may not get in future. As simple as that. Okay. So therefore, income available and thereafter income available for distribution and net assets. So whatever the information given in the question, we have to classify whether it is a capital receipt or revenue receipt or where to treat it, whether it is income statement or net asset statement. If so, what is the treatment? If so, what is the treatment? And end of that is the income computation. Income available for distribution, issue price, repurchase price, and this is the point. This is the net assets value. Okay, right. That's it. In the next class, we'll discuss the subsequent problems. Just go through this problem, spend substantial amount of time. You will get a lot of concept on this problem. Okay, so spend good amount of time on this problem. Do it slowly. Do this problem completely. You'll get do the problem completely. Okay, right. So next problem we'll discuss the next class. See you. Bye. See you.